Hello, everyone. Welcome to this week's Fast Track Money live session. And today, as usual, I'm with Matthias Richter, Financial Imagineer. Today, our topic is about inflation. And if this is your first time watching us, either from Facebook or from YouTube channel, I'm Yasi. I'm behind Fast Track. It's a content platform. We have Fast Track podcasts and also a website where you can read different articles about personal finance, about career, about entrepreneurship. And then today with me is Matthias Richter. He is the creator behind Financial Imagineer. It's a blog where he shared lots of his personal experiences, how to help you to manage money, to create wealth, and then to Imagineer your life financially. And Matthias Richter, so what are we going to talk about today in terms of inflation?
Okay, inflation first and foremost. Welcome everyone. Thanks for being back with us. I can hear myself. So we are okay. Good, better. We're going to talk about inflation, what it is, why it is something important, how it works against you usually, and how you can make it work for you. That's basically in a nutshell. And then we maybe have some, if we have enough time, some historic excursions to some times where inflation happened in the past, how people did during these times, and what we can learn from that. That's the plan. And of course, as usual, please shoot in the comments. This is an open Q&A session. I'm very happy to see any kind of questions. Thanks, Dan, for the haircut. Yes, this is my own haircut, my own work. Haircuts are also inflationary, getting more expensive. So I bought a hair cutter myself, and I try also to get better every time I do it.
In our description, we wrote that who holds cash? Rich people holds assets, and poor people or middle-class people holds cash. Can you explain to the audience what do you mean by that, even though it sounds a little bit harsh?
Well, it's a harsh reality somehow that if you look at most of the very wealthy people, if you look at the composition of their net worth, usually they do have a tremendous amount of their net worth not in cash, just to say it like that. And usually, yes, the wealthy people get wealthy because they have equities, they have real estate, they have business ownerships, they have other things than cash. And if you look at the more middle to lower class people, usually you can say it's probably because they don't have alternatives or they don't plan ahead in that side. But most of them, they are mainly in cash. So cash is a larger portion of what they hold. It may be that they are not educated, they don't know what to do with their money, and then inflation happens. And inflation is usually taking away the purchasing power over time. Maybe I come to that in a minute.
And when you say inflation happens, how inflation evolve over the years?
So sometimes inflation is faster, sometimes it's slower. It depends on where we are on economic cycles. And sometimes, especially when there's a lot of money printed or when there is things like political powers are shifting, or when some governments have huge piles of debt that they have to reimburse or pay back, usually after wars, or it happened when currency systems like the Bretton Woods system changed in the early 1970s, the financing of the Vietnam War, after Second World War. There's certain periods in time where money loses its value. And simply what it means is your $100 today maybe can only buy you, let's say, $90 worth of goods next year, and then maybe $70 worth of goods the year after, and so on. So what you get for your money, the nominal amount, of course, $100 stays $100, but what you get for that will change. And that's what it's called. You lose your purchasing power.
And as we've seen in the last year, during the pandemic, what the US did, what other countries have done, is that also triggering inflation, you think?
Not yet. At the moment, not yet. There is a risk to that, but the great thing about it is, think of it like the economic engine. You have like an engine in a car, and every engine, for making it work well, it needs to be oiled. So it needs to be oiled with something that is called money, cash. And the cash, the money, has to run around in the economy, so it has to be used. And now if something happens like the pandemic, people are starting to sit on their cash, and the economic engine is drying out. And therefore, the additional influx of printed money so far did not have a big impact on inflation for now. So I think this is similar like after the great financial crisis, 2008 and 9. It's very interesting how they actually managed to reduce some of the extended balance sheet again after the crisis. And I think it's really, really something special, because they have to be extremely careful not to do it too fast or too quick. But this is now probably how they will handle money policy going forward, instead of just the interest rate, because interest rates have been very low. But still, now if you see the economic recovery maybe picking up speed and eventually it can overheat, then you see probably, as a lot of money is pumped into the system in the US or in Canada, I have seen housing prices are exploding. So certain parts of the economy, you see a lot of inflation at the moment. But if you look at the CPI, the Consumer Price Index, which is a basket of goods, mostly the negative part of that is it does not reflect some of the asset price inflation that we see, such as stock market, housing price, and other things. Their inflation doesn't show. So if you just look at how much is your bread, your water, your everyday usable things, their inflation is not pushing through. But if you look at the wider area, like including assets, then we have inflation at the moment.
Mm-hmm. And for our audience who are not very familiar with all the economic model behind this, earlier you mentioned the nominal value, like $100, you have nominal value stays the same, but the real value is maybe $70 or $80 or $90 below. So can you explain a little bit more? What does it mean?
Sure. So one thing, maybe you have heard of the Big Mac Index before. The Big Mac Index is very, very famous. It's basically the index showing you how much does a Big Mac cost in each country. And you see probably in some countries, sometimes it's cheaper, in some it's more expensive. The essence of it is, what is the purchasing power of your paper money? That's as easy as I can put it, probably. And if you say, okay, what is inflation? It means simply that from year to year to year, your current money, the one that you have in your pocket, can buy you less Big Macs or something else for that matter, right?
So in a way that the Big Mac price goes up, but even though you have the same amount of money, you buy less Big Macs over the years.
Yes, in a way.
Mm-hmm. And you also mentioned that when average person, if we go to supermarket, we see a loaf of bread, we see eggs, the price does not change much, but overall there is inflation. And how would the average consumers experience the inflation moving forward?
Well, look for instance at imagine you are someone who is planning to buy a house, and then you probably, some people start out and say, oh yeah, for a house I need, I don't know, 100,000 as a down payment or an apartment, right? And then by the time you get your 100,000 together, you recalculate again and you realize, oh sugar, I actually need 150,000 or I need 200,000. That's like this kind of stealth inflation in the asset price part. And that happens if you are not invested with the market. And that's like something you have to participate. And if you just save up your cash, probably it's you have to have an investment plan that is a little more long run, right? But if you put your money at work, let's say you buy shares, and somehow because of asset price inflation, the shares also go up. By the time you actually can buy your house, the shares should have made up for that purchasing power difference. And then at that point in time, you can sell your shares and buy the house. Of course, that's perfect theory. It doesn't happen like that. Share prices fluctuate, so do housing prices. But this is how it should be done over longer times. That's the logic behind it. But if you sit on cash, maybe you will see how everything, all your goals, your asset targets are running away.
I remember back in 2005, 6, like in China at that time, if you buy a property in a city which costs, let's say, 300,000, back then it was like a huge amount of money in local currency. And then inflation happens like 15 years later, 300,000, you couldn't even buy an apartment with a down payment. It's not even enough. And then the mortgage people took back then, imagine 20 years mortgage, and each month based on 300,000, you pay, I don't know, maybe 1,000, 1,500 per month. And then nowadays, like the mortgage you take would be 5,000 per month versus 1,500. So my next question is, do you think like real estate would be a good investment to hedge against inflation?
Real estate is one of the most pure asset price hedges that is around. It's maybe not giving you as much upside as stocks, but real estate, if you do it with some buffer on the side, you have at least a place to stay, and you have a foot in the door, so to say, in the economy. With it come also other things that you have to consider depending where you live. Some countries maybe will have to finance their debt, right? So that's why inflation is expected to happen. Then the question is, how will they pay the debt? Is it by putting up taxes? If taxes go up, why can't they think of taxing the people that have real estate? Then you might be screwed, right? So it could be something more complex than simply say yes. But overall, in general, I think real estate, if you are planning to stay where you are, it's a very good hedge against inflation. Because as long as the place with real estate, you buy nothing else than a foot in the door in the economy where you want to stay. And if there are more interesting jobs, they are paying higher salaries, and inflation happens, well, boom, your real estate price should go up, right?
Yeah.
But of course, if you choose a place where people actually leave the country, where companies leave, where they are overtaxed or things go south, then it's not the right thing to do. So it depends. It's a little more complex than that.
It sounds a little bit frustrating for the audience, like, hey, there's inflation, what should I do? And then buy real estate depends.
It could be. It's one of the solutions. Yes, it's one of the solutions.
What are the other solutions for average investors, average consumers to hedge for inflation besides real estate?
Definitely shares. So if you look at sometimes the more conservative ways to hedge is you look at without putting it as an investment tip now, you look at a share like Nestle or Unilever or companies that produce or sell foods, right? So let's say I am Nestle and I have my Nescafe, my coffee powder, and today I sell it I sell the Nescafe at the machine for $1 per cup, and then maybe inflation happens in 10 years, I sell it for $10 a cup. Guess what? Their profit margin will be the same. If it's 30% today, it will be 30% in 10 years. And therefore, if you have the Nestle share, you are you own parts of that company. And if inflation happens on the coffee beans or whatever, they will be able to push it through to the consumer. And as long as people drink coffee or water or whatever it is they sell, you will be hedged, right? And then, of course, in the meantime, there will be some fluctuations. It's not a straight line, but in the longer term, yes, that's one thing that works. Another thing people usually look at is gold. Gold, I think it could be a short-term hedge. If you look at studies, what happens if you hold gold for like 10, 20, 30 years, it usually underperforms a lot. So I think gold is maybe interesting in the short run. And of course, the big elephant in the room is Bitcoin and all the cryptos. You see, probably because of a lot of money is printed and a lot of young people, they haven't invested before and now they see new things, right? So there is also a lot of money going into these solutions at the moment. And you saw last weekend when some governments start to talk about should we have some regulations on that? You see how the price is moving, and well, whether or not that will be a good thing, it could be, right? Never say never, but there is still a lot of question marks. It's not so proven, like for instance, Nestle and selling food, or agricultural land and things like that.
Yeah. This reminds me of the story you wrote. You interviewed friend, the Bitcoin millionaire. At that time, the price was, I think, 37,000.
Yes,
has
correct.
been a long time below 10K and below 20K. And then it hit 37,000. It's like, wow, so high. And then now you're looking back, it's like, wow, so too early.
No, you never know, right? And for him, I think he told me very clearly he sold exactly at the moment where he was very comfortable. So I think if you speculate or trade with these things, you have to be clear what you want to expect, and you have to look at the potential down as well as upside. And if you call it a day and go out, he didn't, because he said, I have twice as much cash. He sold a part for $12 million. And
12 million.
Yes, he liquidated around 12, and that one was way more than enough for him to retire and do whatever he wants, right? And of course, you can say if he wouldn't have sold then, now he would have 24 million. Yes, like may have, right?
Yeah, like you always said, fear and greed.
Fear and greed, yes, and I think he has a very happy life at the moment.
Yeah, Great. And now, can you give us some examples of like super hyperinflation and
yes. Okay, well, I have I like these kind of banknotes. I show you. Have you ever seen a centatrillionaire? So I love to show this banknote. You have seen it probably.
Wait a second, I'll blow it up. Okay. Let me see how I can make yours. Okay.
Okay. This is $100 trillion, and this has 14 zeros. I don't know if you've ever seen that. So you can call me centatrillionaire. I love that expression.
In which country?
This is Zimbabwe. And you see here, I promise to pay the bearer on demand for the bank, the Reserve Bank of Zimbabwe. And then here, Dr. G, he even signed it off, right? But how much can you buy with that? This is inflation, right? 100 trillion. It looks so cool. It looks so powerful, right? But when this one was issued in Zimbabwe, it was actually worth roughly $4. 4.
Okay, then now how much does it worth?
It became toilet paper. That was the last one they issued, because before every 1 or 2 months they had to add some zeros because inflation was running away. And the problem with them was they had too much government debt. It is the government debt that killed them. And they had only one way to, because they couldn't raise taxes, there was no way to pay it back the normal way. So they printed money to pay back their debt. Because that's the interesting part with inflation is debt is nominal. That means if you, let's say you buy a house, go back to your example in China. If you would have bought your house back in 2005-06, you would have gotten the mortgage, right? And maybe that mortgage, how much would it be now? It is still the same. The nominal amount will not change, but the house price goes up. So that's the beauty of real estate, to go back to that point. You have leverage on it. And if you actually have debt, imagine you have debt. Imagine you're in Zimbabwe, and imagine you would have borrowed 100 trillion 1 year before they issued these banknotes. It would all be yours. And what if you would have bought a house with that money? You can actually later, with a piece of toilet paper, you pay back your debt. And I think that's the interesting part at the moment. There's so much debt creation in this world. And I always think, if people ask me how to be aligned, I mean, yes, if you have the ability to have some outstanding loans, don't do it as an overkill, right? And don't over speculate or over leverage. Please don't. But if you have the ability to borrow something in a comfortable way, do it, because if eventually there will be some changes on the monetary system, if you are aligned with the central banks, you will profit alongside them. And that has always been like that. So to go back in history, Germany had hyperinflation in the 1920s because the other European countries pressured it to pay back some payments for the First World War, which led to the Second World War after. If you go to the 1970s, there was Nixon actually. He wanted to pay more money into the Vietnam War, and because the US dollar and other currencies were kind of fixed and pegged with the gold standard, he couldn't print more than he had gold. So there was a shortage of money before that, and that's why they decided to uplift Bretton Woods. And from 1970-71 onwards, if you look at US dollar, but also the British pound charts against more stable currencies, I like to look at it against the Swiss franc, you will see how, actually, just to have some samples, in 1971, one British pound could buy you 12 Swiss francs. No kidding, 12 Swiss francs.
And which now, year, 1971?
Yeah, around
40 years ago, okay. No, 50 years ago.
50 years ago. 50 years ago. And now you get maybe 1.2, 1.3. So if you look at the nominal part, your pound can buy 90% less Swiss francs.
Yeah.
These both countries are like 500 kilometers away from each other. We never had a war since then here. It was always peaceful. And the economy has been growing. But yes, 90% difference in nominal purchasing power. It's incredible. Things like that, right? So if governments are pressured, and if you would look at the Southern European economies before, like Portugal, Spain, Italy, right? Sorry if you are from there, right? But you probably know you had the lira, you had the pesetas, all this, right? It had a lot of zeros every once in a while. And as well, after a few years, usually they will have a currency reform, which is the other thing, right? So imagine you save up very, very hard and you have some cash piled up, and then the government comes and does a currency reform. There was a currency reform in Taiwan from the old Taiwan dollar to the new Taiwan dollar, where they canceled 4 zeros overnight. That was on a Sunday evening. They say from Monday on, you have 4 zeros less. That one applied for the people who had debt, but it also applied for the people who had cash savings. Guess who was more happy after that?
Who? Government?
They achieved their goals, right? So they kind of leveled back. It's like a reset of the economic machine. And the people who saved up, they actually financed all their debt with the people's savings in the system, right?
So imagine in that situation, it's better off that you have some debt.
Actually, first and foremost, assets, because if you look at assets, you have a house, it's worth 1 million, and then tomorrow it may be worth 5 million. Well, 5 million what? 5 million umbrellas, 5 million clouds, 5 million, I don't know what, right? So it could be 5, it's like Celsius and Fahrenheit. The thing is the same thing, but you just have 2 different measure sticks. And when a currency reform happens, the asset will still be valuable, but the debt is the nominal part, which will evaporate eventually.
Yeah.
Sorry, we have a question. Poppy, thank you for asking a question. Curious about your international asset allocations. Also, do you hedge into a preferred currency? I assume that's for me, right? Okay.
Definitely for you, yeah.
Okay, I think yes. I prefer Swiss francs and Singapore dollars at the moment. Swiss francs is more stable currency in Europe, and against the euro. With euro, I have some concerns. What's going on, especially in Italy? I have seen they have increasingly high amounts of government debt there. If interest rates were just at 1% instead of minus 0.4 or something like that, I think they will have tremendous problems there. So I rather keep money in a more safer currency. And in Asia, I prefer the Singapore dollar, because that one is a basket of currencies. But eventually, if Asia would get stronger, you will profit from whatever macro-driven change is happening there. And they actually have slightly higher interest rates as well as in Europe and in North America. And they have the upside. Of course, you have yuan, Taiwan dollar, South Korean won. You have all kinds of currencies in there, and you will profit from that.
And you talk about hyperinflation earlier on and the interest rate. What happens on the deflation happens? What happens if there's a negative interest rate? Then would people who have assets will be, in disadvantage, or what do you think about that?
Okay, actually, that's probably what we have seen in Japan. I can make a big excursion to Japan. You probably know, well, we have about 5 minutes left. I try to keep it short. In Japan, the Nikkei index reached like 40,000 points in 1989. And then until now, it never went back to these highs. And after that, the Japanese yen got very, very strong, and people did not like to spend too much. They like to save. And then deflation is the opposite. That means if you have $100 today, maybe next year your $100 can buy much more. And another 2 years later, it can buy even more. So people will be reluctant to put the money back into the economy. And I believe that's why at the moment we have negative interest rates, because the central government is trying to fight this deflationary pressure, because your money could be more valuable in the future. And that's why they print so much to flush it together.
I was reading the report that during the pandemic, in many nations, that the people have been holding on to so much cash and not spending them. And there were some new measurements is going to encourage spending and consuming.
Yes.
Yeah.
Yeah, that's keeping the machine oiled, right? So at the moment, the governments try to add oil, and one day they have to stop it. And then hopefully consumers flock back. I see it now in some places where they reopen restaurants. There's a lot of demand. And Switzerland is not the only place where people saved a lot. I saw in the US, it's like 20 or 30% more saving rate than ever before, because there was simply no opportunity to spend that money. So there's a lot of cash piled up, which could be actually flocking into the stock market. It could be going into other things, right? There's a huge delayed consumption, which may or may not come and translate into inflation eventually.
And for individuals, if you are holding on a lot of cash, like we'll be mentioning in our money course, that how you should do with your savings, like increase your savings and then invest. I hope you're not saving over the lockdown period and then going to the shop and then treat yourself.
Yeah. Oh, yeah, exactly. So I think most people, they save much, much more. Otherwise, the average would not be so high. It would be almost impossible.
Yeah. But, let's see this year and the next year when everything open up, if the savings if the savings go to stock market or go to the shops.
I believe this year was very interesting. I think a lot of people, they were forced to save in a way. Maybe some people, they woke up and say, actually, I can save so much, right? I believe I know people, they haven't even considered that they could save that much, but it happened. Simply because there was less opportunity to spend.
Have you read this news that in which city, southern China, Guangzhou, somewhere, when the lockdown finished the last day, people can go to the shops. Is it Acme's shop? Their one-day sales, one-day sales is equal to, I don't remember, like the whole year sales of this shopping street in Hong Kong.
Right?
Yes, I don't remember the details, but there was.
Yeah, it's like you see how much shopping means to some people, and then not to judge that, right? It's a human emotion to try to find ways to make yourself happy. But I think Yase and I, we can agree to, maybe we hope anyone who is listening to this or watching this, I hope you guys have learned maybe that this is possible to save it and then better put it into investments than to just waste it away, to prepare for a better and healthier financial future.
Yeah, instead of buying, how to say,
depreciating assets
by
or even worse, liabilities.
Yeah, and one of the appreciating assets, I hope so, it's gold. I think we're going to talk about next week.
Yes, we have that lined up for next week. I think gold is a very interesting thing. People always remember gold when things go bad, and but gold is something I can also bore you for hours on that. And I think I have some things in mind what I want to cover next week about gold mining shares, the gold industry, about how much gold is there in the whole world, where is it held, what does it mean, who is buying, who is selling, the whole dynamics in that. I think it's a highly interesting field. Also, that if you have gold, maybe one fun fact: did you know that I think the paper gold assets versus the actual physical gold assets is like 200-300 to 1 or something like that.
Okay.
There's a huge like derivative bubble there in that field at the moment, which could be extremely dangerous, to say it like that, for price action. But we don't know what would go on there if things change.
Yeah.
Or let's see another comment. Popeye, thank you for about not spending. Yes.
Most in US bought what we actually needed, where online shopping so much is spent almost just for the sake of spending on non-necessities. I think it's quite common, not just in the US, but also in other countries. Due to commercials, social media, people are driven to spend more rather than buying things what they need.
Yeah.
Needs and wants, yeah.
The needs and wants, yeah. Know your needs from your wants, right?
Yeah.
Any other questions from the audience, maybe about inflation, about anything? Now is your time to write.
Did we cover needs and wants in one of our live sessions?
I don't think we did yet. That could be another topic. I think it's a very good one.
I'm curious how the audience will react if we present some item that we think it's needs, and then people will say, oh, that is a want. Or if we present something as a want, and then people might associate it as a need immediately.
It's a highly personal thing.
Yeah. So if there's no other questions, then I think we are coming to the end of today's live session. Thank you so much for every single of you being with us today, asking questions, making comments. And if you're interested to learn more about how to manage money and all in one go and then master the money skills for life, feel free to register our money course, which will be opened in May, another batch. So right now we are running one batch, and all the details will be in the description in the show notes below. And the next week we're going to talk about, shall you buy gold or not?
The yellow metal. Yeah.
All right. Thank you, guys. Bye-bye.
Thanks so much. Bye.